You are welcome to LoudTech Open and Distant Learning. I'll be taking you through ACT 302 Cost Accounting 2, Study Section 9, and we are looking at ratio analysis. Ratio analysis is used to evaluate relationships among financial statement items. The ratios are used to identify trends over time for one company or to compare two or more companies at one point in time. Financial statement ratio analysis focus on three key aspects of business, which are liquidity, profitability, and the solvency of an organization. In this study section, you learn about various methods of calculating ratio analysis. Learning outcome for study section 9. On completion of this study section, we expect the student to be able to define ratio analysis and determine how to calculate current ratio and quick ratio. We also expect the student to be able to calculate debt ratio, debt equity ratio, and equity multiplier. Of course, they should be able to determine receivables turnover and days receivables, as well as inventory turnover and days inventory ratio. They should also calculate profit margin, ROA and ROE. And of course, they should be able to calculate market value ratio such as PE ratio, that is price earning ratio. We have categories of ratio analysis. We have about 5 categories of ratio analysis, which are very important in terms of analyzing the financial component of financial statements. We have short-term solvency ratio, we have debt management ratio, we have asset management ratio, we have profitability ratio, and we have market value ratio. That's the basic categories of ratio analysis. Now we'll be picking them one after the other. Let's look at the short-term solvency ratio or liquidity ratio. We have components that comprise or that we use to calculate the short-term solvency ratio or the liquidity ratio. We have current ratio and we have quick ratio, which are the major two method that we use to calculate for short-term solvency ratio, or if we are considering the liquidity ratio. For current ratio is calculated by dividing current assets by current liabilities. Current assets are the assets that the firm expects to convert into cash in the coming year, and current liabilities represent the liabilities which have to be paid in cash in the incoming year. The appropriate value for this ratio depends on the characteristics of which the firm's industry and the composition of its current assets. However, at a minimum, the current ratio should be greater than 1. That is our expectation. And if you look at it from that point of view, we said the current ratio is equals to the total current assets over total current liabilities. So if you are considering the short-term solvency ratio, it's an attempt to measure the ability of a firm to meet its short-term financial obligations. In other words, the ratio seeks to determine the ability of a firm to avoid financial distress in the short run. So the two most important short-term solvency ratio are the current ratio and the quick ratio. So the quick ratio can also be called, or we can refer it to as the acid test ratio. The basic difference between the current asset and the quick ratio and current ratio is that the current ratio consider current asset and current liabilities. That is, total current assets were considered and total current liability were also considered. But in terms of the quick ratio, we are not considering inventory, which is the stock, when we are calculating the quick ratio analysis, the quick ratio for the quick ratio, because we expect that we need to make it quick. And if you are taking it quick, we are not considering inventory, we are only considering cash and other things that are equivalent to cash. The debt management ratio. Debt management ratio attempts to measure the firm's use of financial leverage and ability to avoid financial distress in the long run. This ratio are also known as long-term solvency ratio. The debt ratio, debt equity ratio, and equity multiplier are essentially three ways of looking at the same thing. The firm's use of debt to finance its assets. The debt ratio is calculated by dividing the total debts by total assets. The debt equity ratio is calculated by dividing the total debt by total owner's equity. So the equity multiplier is calculated by dividing total assets by total owner's equity. That is the three basic formula that we have under debt management ratio. That is, we consider debt ratio, we consider debt to equity ratio, and we also consider equity multiplier. Asset management ratio. Asset management ratio are looking at receivables turnover and days receivables. What does that mean? The receivables turnover and days receivable ratio assess the firm's management of its accounts receivables and its credit policy. In general, the higher the receivables turnover ratio, the better, since this implies that the firm is collecting on its account receivables sooner. So however, if the ratio is too high, then the firm may be offering too large of discount for early payment, or may have to have too restrictive credit terms. So the receivables turnover ratio is calculated by dividing sales by account receivables, and account receivables arise from credit sales, so it is more meaningful to use credit sales in the numerator if the data is available. Now, fixed and total assets turnover. The fixed assets to turnover ratio measures how productively the firm is managing its fixed assets to generate sales. This ratio is calculated by dividing sales by net fixed assets when comparing fixed assets turnover ratio of different firms. It is important to keep in mind that the value for net fixed assets reported on the firm's balance sheet are book value, which can be very different from market value. So the total asset turnover ratio measures how productively the firm is managing all of its assets to generate sales. So this ratio is calculated by dividing sales by total assets. Profitability ratio. Profitability ratio, we are looking at it from three perspectives. We are considering the profit margin, we are looking at the return on assets, that is the ROE, and we are looking at the return on equity, which is the ROE. Now, what is profitability ratios, or what it is the effectiveness of this ratio analysis? Profitability ratio also attempts to measure the firm's success in generating income. That is, what is the performance, financial performance of an organization. This ratio reflects the combined effect of the firm assets and debt management. And the return on assets ratio, or the profit margin, as we said, that when we are looking at the total income over our total sales. Then whatever that happens will give us our profit analysis. That is the strength of our profit. For return on assets, this indicates the naira in income earned by the firm on its assets, and the return on equity ratio indicates the naira of income earned by the firm on its shareholders' equity. It is important to remember that these ratios are based on accounting book value and not on market values. So it is not appropriate to compare this ratio with market rate of return, such as the interest rate on the treasury bonds or the return earned on an investment in a stock. Now let's talk about the return on equity. Return on equity that is the return on asset ratio, which we have said the other time. The both analysis can go for both return on assets and return on equity. Market value ratio. Market value ratio. The market value ratio relates and observable market value, the stock price, to book values obtained from the firm's financial statements. And we are looking at the price earnings ratio. This price earning ratio is calculated by dividing the current market price per share of the stock by earnings per share, that is the EPS. The earnings per share are calculated by dividing net income by the number of shares outstanding, as you know. Now, the PE ratio indicates how much investors are willing to pay per naira of current earnings. As such, high PE ratio are associated with growth stock. That is, investors who are willing to pay a higher price for a naira of current earning obviously expect high earnings in the future. So in this manner, the PE ratio also indicates how expensive a particular stock is. This ratio is not meaningful. However, if the firm has very little or negative earnings, so if you are calculating earnings per share, we said the total net income over number of shares outstanding. Now, we are looking at market to book ratio. The market to book ratio relates the firm's market value per share to its book value per share, since a firm book value reflects historical cost accounting. This ratio indicates management success in creating value for its stockholders. This ratio is used by value-based investors to help to identify undervalued stocks. We have come to the end of this study section. Thank you for listening. See you in the next class.